The housing market is starting to shift in a way that we really haven't seen in a number of years when it comes to inventory, when it comes to housing, when it comes to mortgage. And that's exactly what we're going to dive into in today's video. We're going to take a step back from kind of, a full outline, if you will, and go through what Josh and I are seeing in the housing market as a full-time real estate professional and as a mortgage professional, talking to a lot of different people across the nation. There's some imbalance, if you will, in the housing market. And it's, what you need to be aware of if you're thinking of buying or selling in this market. So, Josh, we're often having conversations. We're often getting a lot of feedback. And, we have the advantage of talking to a lot of different people, seeing a lot of different things versus just the home buyer reading what's online or knowing what's happening in their market. So I thought it would be advantageous for us to be able to provide some information to, those listening out there, provide some context and help guide them through the process and help them become educated home buyers. So I want to start with inventory, Josh. We talk about it all the time. It leads, the direction of housing, and we're starting to see a little bit of imbalance there. So why don't we start there?
Yeah, the big picture is this is where we go back to you must know your local market. All real estate is local. You're going to go through these numbers for us, some of the areas of the country that are seeing a big pickup in inventory and what that's doing to market times, pricing, what it will continue to do with pricing going forward, assuming that the current trends stay in place. But that's the big one, is just knowing that if you're in Southern California, or if you're in the Northeast, probably the two hottest markets right now, if you're looking at national numbers, these national numbers are getting distorted because we have big discrepancies depending on where you are, and that you have the data to go through that.
Well, actually, why don't you elaborate on that a little bit? Discrepancies, right? So, real estate's local. We follow closely what's happening in Southern California, and to some degree, we follow what's happening across the nation. But unless you're in it, unless you're actively going through it, it's hard to really understand it. And I talk about it all the time, and that's kind of where this conversation's going. It's what I'm actually seeing out in my market right now, because I feel like that's really what helps buyers. Hearing numbers and hearing what's happening, and it's like, oh, okay, that whatever, but how does that actually affect me? And that's what I want to talk about. But I think these distortions are important in helping people understand why the headline might read a little bit differently depending on where you're located.
So the big thing that we're seeing, Jeb, in the data is that the Gulf Coast states, so Texas, the whole entire state, but especially the area over towards the Gulf Coast, Louisiana, Florida, which you also have, Mississippi down there in the Gulf Coast. Some of these other coastal areas can be having issues. But I was on a call last night with a loan officer from Mississippi. She goes, no, our market is very stable. You're not having the bidding wars. You're not having long market times. It's a pretty stable market for everyone to enter into. But what we are seeing is both Florida and Texas are way up. I don't think either of them are quite to the level of inventory that we had 2019 pre-pandemic, but big increases, 30, 40, 50% increases in inventory year over year. And it has not yet translated into big changes in pricing. But if you're a buyer in one of those markets, you need to be aware that the strategies that you needed to use last year are certainly not the strategies that you need to use this year. And we talk about the importance of the pros that you're working with. I can tell you, I work with a lot of buyers everywhere around the country, at least in the areas that were approved. So if I'm working with someone in Pennsylvania, that's not a realtor that I've worked with before. And I can tell you, it's less than a 50-50 chance that realtor really knows their market and can advise you on what is happening. And I can say, it doesn't matter where you are, whether you're in one of the strong markets or whether you're one of these markets that's seen the inflection point, you need someone that knows and understands data, that either they're subscribing to the local services like we have. We brought on Steve Thomas from here in Southern California, which he covers all of California, is going out to Phoenix and Nevada here soon. But there's the Crumford Report in Arizona. I'm sure there's something the same in Florida. I'm sure there's something in the Northeast. There are big national services, but there's people that track this data. So if your agent is not tuned into that data, if your agent isn't adept at going into the MLS and looking at the numbers, seeing the numbers from their state association of realtors and staying on track of that, they're not going to be able to advise you what is happening, both statewide, countywide, citywide, and down to the zip in the neighborhood that you're interested in, and being able to show you on paper the trends. Have we seen a change in market times? Have we seen a change in asking prices? Have we seen a change in closing prices? That's the data that you need locally to be able to make sense of nationwide inventory numbers that are being distorted by the big changes in Texas and Florida. Because for the most part, the rest of the country is not seeing that.
No, and we're going to talk about what I'm seeing out there as a real estate agent now, like with what's happening with open houses and what I'm seeing with offers and that sort of thing. But I do want to talk about the actual numbers here because I think they're important. So inventory is up 30% year over year, which sounds like a huge number. Like, wow, inventory's up 30%. But you have to understand the baseline that we're at. It's such a low level that increasing 30% isn't as big a shift as the number makes it sound. Because you think, wow, I mean, that is 1/3 more houses. Holy crap. I mean, there must be so much inventory. No, it's because it's in selected markets, kind of like you mentioned a moment ago. Texas and Florida. Texas went from being 10% of the national listings in May of 2019 to now representing 17% of the listings out there at the moment. And what does it say? Texas and Florida are making national listing growth appear better than it likely is in your market. And that's because you're seeing those inventory levels. And I think, again, some of these levels are back to 2019, Josh. I know you mentioned a moment ago, we're not quite back there. I think Jacksonville and some of these markets are there. Now, when you talk to Texas, Dallas is actually not there yet. The state of Texas is, but Dallas hasn't increased at the same pace as a lot of these other markets. So when we say real estate's local, don't just focus on Texas, focus on Dallas, focus on
Your
more
market.
specifically areas of Dallas where you're looking to purchase.
And to that point, Dallas is still a relatively strong market, but the two of the agents that I was on the call with last night, one is an agent in Dallas-Fort Worth, and another is a loan officer in El Paso. El Paso, much more affordable, and their market is much hotter, so much stronger. It's not like on fire, like, oh my God, you got to overbid. Because our market's pretty strong. We're not seeing any weakness. Seller brings a home on the market price right, it's going to sell. And the agent out of DFW is saying, hey, we see sellers not adapting to where we're at right now. They're still pushing sale prices. So the people that are realistic and come on at a good price, those homes sell. The people that think, hey, the last one sold for this, I get 5% more, are having a hard time. So there's this inflection point, and what they're seeing more of is at least sellers willing to give some concessions to make a transaction come together. But to the point of, this is all anecdotal. We're talking to individuals in individual markets. We're going to talk about what you see, what I see. Yeah. It is important that you get to as much data, local data, as you can when trying to make sense of these numbers for yourself.
And then talking about that, 65% of major markets out there actually have more inventory than they did last year. Here in Southern California, we have more inventory than we did last year. But when you compare it to last year, I think around this time last year, we had like 2,200 properties on the market. This year we have 2,300. I mean, we're talking really small numbers. So yes, there's an increase, but understand the context, understand where you were prior to the pandemic. This time prior to the pandemic, we would have like 6,000 homes on the market. So still well below that trend. It's increasing. Josh, I think we'll probably both agree on this. Inventory is likely to continue increasing as rates stay above that 7% threshold. There's a really high likelihood, you might not agree with this part, that we see 8% again, close to it. I'm not counting it out at this point because I don't know that the data is going to allow the Fed to do anything differently for the foreseeable future, and spreads aren't getting much better. And yeah, so I think there's a chance that we could push back towards 8.
I don't necessarily disagree with you. So what does it mean? Like, really, in the markets, that means we're seeing a 5% 10-year treasury, and you've marked up the charts. We've looked at it, and it's hard to make a case that technically it does not. Technically, it does appear that we're heading to a 5% 10-year treasury, which keeps you with rates just below 8%. That was a pretty hard ceiling that got rejected really, really hard in the third quarter of last year and started that run down lower where we probably shouldn't have ended up. We had talked about through the holidays, hey, if you like these rates, lock them. That's too big of a move, too fast, unlikely to hold. But to that point, Jeb, what did we see? We saw more sales than expected in the early part of the year. because we'll go through a little bit of the lock-in effect. The lock-in effect is real. I'll tell you the conversations I'm having with sellers who want to buy. I don't talk to sellers just because they want to sell their house. I talk to sellers because they say, hey, cool, we're thinking about selling. I would like to buy another house. What does that look like? But that lock-in effect is real. We started seeing people when you could get a 6.25, 6.375, or an FHA at 5.875. Those people are like, okay, I don't like it, but I'll do that. So there's that interesting point that rates going up will keep a lid on inventory, but inventory will likely grow because what comes to market gets absorbed less slowly because it hurts demand. Demand is at record low levels. Like people say all the time, there's record low levels, or going back to the 90s, the lowest levels of applications, lowest levels of home sales. Absolutely true. But it goes back to that equilibrium where we don't have a lot of homes coming to market. We don't have a lot of buyers to buy them. But in most markets, other than those few that we talked about, we're seeing more than enough to keep prices stable or growing. We had both Case-Shiller and FHFA came out with their indexes, and this is the hot part of the year. We're starting to see that pickup from early spring. So we should expect these would be the high numbers for the year, but I believe both of them were in the sixes. One might have been high fives, but low 6% year over year, which is hot. That's higher than the long-term average of mid to high fours in a market where affordability is incredibly constrained. So it's easy to look at the data and go, hey, limited demand because of affordability. 100% true. But most people don't want to look and go, very limited supply, because most people are just saying, I ain't selling my house because it would cost me too much money to replace it, either in a rental or a new home.
Well, let's talk about the people that are selling their house. But before we do that, if you find any value in the episode that we do here, in the content that we provide, do us a favor and hit that thumbs up. And if you want to stay updated on information like this and become the educated home buyer, do us a favor and subscribe to the channel. So Josh, I have conversations with sellers, right? You often talk to the people trying to get loans because that's your job, and me on the other side talking to people looking to buy houses and sell them. The selling side is one of those things that the people that are selling are the people that have to sell for some reason. And you say have to sell. Why would somebody have to sell? Well, in the case of the last 3 listings that I've had and or conversations that I've had with people that are considering listing, got one guy relocating to Texas, right? So he's moving out of state, can't afford to keep both properties, needs the cash for this property to buy that home. That's a reason to have to sell. Had 3 brothers inherit their mother's house. She unfortunately passed away. They inherited the property. None of them were in a position to keep it or pay somebody off, to pay the other brothers off to keep the house. They needed to sell that property. I have one that is looking to downsize. Been in the house for 40 years. House has just become too much, needs maintenance, needs everything else. She's looking for a smaller property. So those are really the scenarios. It's people that have to do something. And you say, well, when is it not that? Like, when do people, that's not the situation? Well, there's often times where people are like, hey, it would be nice to move. Like, I'm kind of at, the maximum space that we can have with our kids. And hey, if the right house came up right now, we may consider doing it if we get the right price for our house. Nobody's putting their homes on the market right now unless they're serious. For one, like you said, some of these people can't justify the upgrade in price along with the, I say upgrade in price, purchasing higher price and paying a higher rate to do it. We're going to talk about what those numbers look like percentage wise, because it mind boggling.
Let's just hold your thoughts. So I don't want to interrupt you, but the numbers actually support exactly what you're saying. From 2000 to 2022, upgrading to a 25% more expensive home would have required the average homeowner to increase their principal and interest by about 40% or $400 per month. So you're getting a 25% more expensive home, increases about $400. So think the average first-time buyer owns for 5, 6, 7 years. You're making more money. You're in a better situation. So you're equipped to handle that. Well, today, that same trade up brings a 103% increase to the payment, or $1,384. If you bought your first home 7 years ago, you've made good money on it, but you have an amazing interest rate. You're looking at that going, $1,384 a month on average. I mean, for us in California, it might be $2,500 or $3,500 per month. 103% increase. No. Lateral moves. So someone just says, hey, I would like a different a different school district. I would like to be in a different city, but I'm going from a $400,000 house to a $400,000 house. Today, lateral moves to an equivalently priced home would result in a 40% increase to principal and interest, roughly as much as the historical trade-up cost. And then the last one says both of those figures are worse for anyone who was able to benefit from the refi market in 2020 and 2021, which is 50-60% of borrowers. So when you say who's moving, people that have to, they may not, it's not literal gun to their head, they have to, but they have a very, very strong motivation to cross that chasm of price.
No, and the one example I left out is the life events, right? So it's like getting married, having multiple kids. In fact, one of our mutual friends just bought another home, sold a home, bought another home, blended family, right? Two families coming together, needed more space. That's the reason people move. Nobody's moving unless they have to. But here's the thing, like, I don't think that's a surprise to anybody listening. But what I am starting to see is some changes in the market. And what I mean by that is I see a slowing down. And you're like, Jeb, what does that actually mean? Orange County is still a very hot market. Inventory is increasing, but what we are seeing is less homes actually below that median price, right? So inventory is increasing, but less available inventory for the people that I think really need the inventory. Inventory is growing because it's at the higher end of the price point, right? Less people typically buy, less people can afford those homes to begin with. So inventory at the higher end is pulling all the inventory up. And so, but open houses, right? Just had two dynamite properties, completely remodeled homes that in 2021, you would have had 50 offers on some of these things. And I'm not exaggerating. I mean, it was turnkey, beautiful, two properties.
Beautiful.
And what I saw on both of those properties is only receiving one, maybe two calls prior to actually putting it in an open house. So typically I'll go on the market on a Wednesday, maybe not allowing any showings for the first couple of days, just to kind of build a little bit of demand for the property while it's, getting some exposure on it. And usually I'm receiving calls. Hey, Jeb, like my client loves the property. We want to get into it. How quickly can we see it? Can we make an offer before? All of these things. I think I may have gotten one call on each one of those properties, whereas normally it would be 2, 3, 5, 10 calls prior to people actually seeing it. So that to me is a sign that things are slowing down a little bit. Even then, open houses are slower, not as many people coming through. And even with that, typically after an open house, somebody sees the property, I would usually get a call from their agent and or the buyer saying, hey, listen, what's going on with this property? My client loves it. They want to make an offer. No, crickets. Like, I'm thinking on Sunday, am I going to get any offers? Am I not? Because I'm not receiving the calls that I normally would have. It's a weird dynamic that, I've got two beautiful properties priced right, and we're not getting the calls. Now, lo and behold, we get multiple offers on both of these properties. They end up selling above the asking price. And it's not a cry to me to sleep story over here, but it is what I'm seeing, and it's changing. And it's gonna end up benefiting the buyer a little bit more, in my opinion, assuming rates stay where they are, Josh. And we can talk a little bit more about cash offers and that sort of thing too.
So from that, you want to transition over to kind of the conversations I'm having, what I'm seeing. Let's close the loop on that. Here's an example with numbers. I'm the numbers guy. You're looking at numbers of what you sell the house for.
Yep.
But we have a listener to the show in Pennsylvania. Just got their application in. They're already under contract, and their issue is upwardly mobile. They're young, early 30s. Both to dual income, making good income, and they had 2 little kids, and now they are soon to have 3 little kids, or just had the second kid. You can tell I didn't look at the kid portion of the application well enough. I believe they have 2, and a third is on the way. And they're like, our house is just too small. So they're buying a 4,000 square foot house, which would be big enough for their family today and into the future. But they're going from a $2,500 monthly payment to a $5,800 monthly payment. That's tough. That's a tough pill to swallow. And he and I have had that conversation. He's like, current house just does not work. So this is the right decision for us. We can handle it. We can afford it, but they have a strong motivation based off of their financial situation, or the strong motivation based off of their family situation. And they're able to do it because they're in a strong financial position and comfortable selling the house, putting a nice down payment, putting some money in the bank. They have 0 other debt, excellent credit, good, stable jobs. So that's the type of buyer that we are seeing. A piece that people always like to ask is, who's refinancing in this market? Well, almost no one is refinancing in this market. If we go back, we ran the numbers, Jeb, through 2020 and 2021, super hot purchase market. So there's a ton of purchases out there, but refis were running 60 to 70% of the market because there were even more people in higher rates that wanted to either take cash out or lower their rate. Right now, we're sitting at 14% of the market. And that sounds about right to me. So again, we go back to crazy times when rates are super low. We're doing 10 to 15 refinances a month. And right now we're doing 1 to 2. So you say, well, how are you even doing 1 to 2? Who's doing it? These are not opportunity based. It's not, hey, I have an opportunity to lower my monthly payment. It's needs based. So you had talked about a couple of things. Divorce. Had a listener here call earlier this week going through divorce. They have 3 properties. One of them wants to keep all of them, and they need to get one another off of the obligation of that loan so they can truly separate their finances and go forward. So that's one of the big needs. The other one, doing one for a listener right now here in Riverside, California. And I don't know how he let it pass him by, but he is at an 8% interest rate. Now that loan is really, really small, but we looked at the debts. He had a tax situation. He's a business owner, a couple of other things. We're like, yeah, this is the cheapest way. A new loan is the cheapest way for you to clear everything out, pay off everything you have, and lower your monthly outflow. So those are the things. People who can benefit from consolidating higher interest debt, have a need for cash that they can't access anywhere or anywhere else as affordably, and divorce situations are the ones that we're seeing. I guess.
No, what I was going to say is, if you're listening and you notice Josh is helping a lot of listeners, and I want you to talk in a minute about some of the conversations you're having with deals that are having issues, because I think it's important for people to understand that, we talk about shopping loans, we talk about comparing other lenders, the problems that you're seeing with some of that stuff at the moment. I want you to elaborate on that. But before you get into that, I want to, if you're in a situation right now, you're trying to get pre-approved, you're talking to people, you want an opinion, you want to talk to an expert like Josh, and work with our team, there's actually a referral link in the description of this video. We'd love the opportunity to help you. We're helping a lot of listeners already. We'd love the opportunity to extend that a little bit further and, really provide expertise through that process. So if we can be of any assistance to you, whether it's getting a mortgage, and or real estate needs, we would love that opportunity. You can actually reach us using that link in the description. So Josh, you're often bitching to some degree about people that are calling you with issues that could have been avoided. Can you touch on that just for a moment?
The common theme when I talk to someone and they're running into problems, when we ask about how did this start? How did you find this person? What did you look at? The common theme, probably at least 50% of the time, they had the best rates of everyone that I talked to. So we talk here on the show all the time. Terms are important. You deserve a great rate. Reputable lenders should be within a narrow range of 0.1% in interest. So if someone's outside of that range, to the high side, it tells you, hey, I need to make at least another call or two to see if that doesn't make sense. One of the callers from the show, literally, they're under contract and they have 45 days till close, so plenty of time to make the switch. And their lender tells them, oh yeah, when we pre-approved you, it was 6.875. Today it's 8%. You talked about, Jeb, rates might be going to 8%. They're certainly not 8% today. So they had options all the way down to like 7 1/8, no higher than 7.5. So that's one type. Someone chased a great rate, but a lot of times what that results in is we talk about what are the other equally important things: knowledge and expertise, but also your communication and comfort level with that person. You have to be able to communicate with them really well, to ask them questions, to not feel dumb, to say, where are we at? What does this mean? Can you walk through this number? Why am I paying that? And if they don't have a really good explanation for it, like oftentimes I will hear, well, yeah, I asked about that and they just fumbled through it, or you got to hear some of the craziest explanations ever of why something was a certain way. But going back to it, half of the situations where someone calls me in a pickle is because they chased the absolute lowest rate, and it was generally from someone who was a liar to begin with, or just incompetent and didn't even know how to accurately price the loan. But the second piece of it is people who went with someone and they have a complex situation and the person they're dealing with didn't appreciate that complex situation. We talk about it. Maybe 30-40% of borrowers are so simple that any average loan officer can get them closed. In the current market, with high debt to income ratios, with lots of student loans going on, all of the complexities that we have in the current market, Most people, 50, 60%, it is not that simple. There's going to be some hair on the deal that we have to unwind. And oftentimes, Jeb, I'll hear from people like, why are you asking for all this stuff? I just want a pre-approval to go look at houses. And say, because when I give you that pre-approval, we're pretty much done. You know what I'm saying? Right. That we're done. You know that we have all uncovered all the potential problems and we've solved them so that there is no stress once you find a home. So those are the big things that we're seeing. A conversation not related to who am I going to do my loan with? What are my terms looking like? Talking to a listener in Texas. She's from California, moved to Texas. We are going to do a second mortgage on her property here in California because she had a bunch of debt. We're going to consolidate the debt. But then she's saying, might want to take some money for me to buy a house here in Texas, about $300,000 for what I need. Single person, doesn't need a big house, not going to have kids. And went through all the numbers. The next day she calls back. She goes, I'm looking at this. She goes, it just doesn't make sense. I can rent a 2-bedroom apartment for $1,700, and we're looking in my payment with the higher tax rate, higher homeowners insurance here in Texas, and be almost $3,000. Said, okay, you're not wrong, but there's more to it than you are taking into account. We can't compare the rent on a 2-bedroom apartment to a rent on a 2-bedroom house. They're two different things. So if you want to do apples to apples, say, how much would it cost me to go rent that house is what you need to be doing. Right. If you're comfortable with an apartment, you're justified to make that decision, but it's not really fair to compare the two to say which is better. Now, this again, I would say 75% chance she decides not to buy. And the big deciding factor for her is, I don't know how long I'm going to be here in Texas. I want to get out of here. Or I might want to get out of here. I like it for now, but I moved here from California, may want to move again. So we look at that and I go, that tells me, yeah, if you're saying, hey, I can rent more cheaply and I like the optionality of being able to pick up and move whenever I want, we don't want to buy. But what we did go through it for the person that does make the decision to buy. Hey, I'm a lifelong Texan. I want to be here. I love this house. They can bury me in the backyard. It's all good. I'm going to be here forever. Well, for that person, maybe the rent is $2,000 and the house purchase is $2,850. That's $850. Almost 30% higher to own. Uh-huh. But a portion of that goes to principal every month. On that size of a loan, it's not a huge amount. $300-$400 goes to principal every month. And if we continue to see appreciation going forward, which we talked about earlier in the show, 4.5% roughly nationwide for the last 40, 50 years. Let's say we get 65% of that. You get 3% going forward. That $300,000 house in 10 years is going to be $385, $390. Okay. You're going to have paid it down to $250, $260. So you look at that, you have $140,000 of equity. The other piece in terms of affordability, we talk about lock-in. So it's 25% more expensive to rent nationwide than it is to own. But if rates drop to 5%, that's a 10% premium. So someone buying now, they suffer from that higher payment, but they do have the option, if and when rates moderate to 6%, 6.5%, 5.5%, whatever that is, they can lower that gap. And despite the fact that you're probably correct that we're going to see higher rates in the near-term future, I am very confident that in the next 3 to 7 years, we're going to have an opportunity to get somewhere in the low 6s, mid to high 5s, which compresses that gap in addition to those other things. So that's what you need to do. No one can tell you you're making the wrong decision. Is renting, when it's significantly cheaper, a potential correct decision? Yes. Is owning the wrong decision because it costs more today? No, it's a personal decision and it involves a big picture view of everything. So those are the big conversations that I'm having with people that keep recurring day in and day out.
And the market is changing, but understand it's not crashing. It's not likely to crash. You need significantly more inventory than we have right now. So inventory is increasing, but it's not to a point where it's a concern. You need distressed sales. You need people that, can't keep their property and have no equity in those situations. And that's not the case. But what I will say, Josh, in kind of closing the loop and finalizing the conversation, there's still a lot of cash out there. The good homes that are priced right still sell. The turnkey HGTV homes that are priced correctly, still getting a premium, selling above ask. I mean, I can say that from experience in the properties I have. Distress sales, the ones that flippers can actually improve, put back on the market, make some money. Those are still selling really quick when priced right. The ones that are kind of in the middle, the ones that were remodeled 10, 15 years ago, partially done, need some work here, there, not really the kind of home that you're in love with when you walk in, and it would take you, maybe some time to do all the things you want to do. Those are the homes that's sitting. That's the opportunity right now in the market, in my opinion. So if you're a buyer out there, just focus on the opportunities. or stay patient and just see what happens. I don't think there's a rush to go out and do anything, but understand there are some changes that are occurring rather that may impact you. So just make sure you're paying attention to your local market. So Josh Thorpe, your way to close this out.
Pretty simple. Know your market. So pick the right pros that can help you know your market and know yourself and know your plans. The numbers are complex. It is a tough and difficult market. But again, there's going to be 4 million sales of existing homes in the US. Add in new homes, close to 5 million pieces of real estate will transfer hands this year. So lots of people are deciding that it is the right decision. So you're asking the right questions, you're educating yourself, but know yourself, know your plans, know the market, work with pros that can help and advise.
And if we can be part of that process, do us a favor and reach out, as we'd love the opportunity to help. But until next time, buy right, borrow smart, build wealth. Adios.
Amigos.